In the intricate dance of global finance, capital flows often reflect underlying geopolitical tensions. Recently, the global financial system has been closely monitoring a simmering dispute between the United States and Europe, not over trade deficits or regulatory standards, but over a vast ice-covered island in the North Atlantic, Greenland. This geopolitical friction has ignited a consequential financial question. What would happen if Europe decided to divest from the United States? This isn't a minor portfolio adjustment. We're talking about a potential liquidation of an estimated $8 trillion in American assets held by European entities. This scenario, however remote, forces us to examine the deep financial interdependencies that underpin the transatlantic relationship and the very structure of global capital markets. The core of the issue is the potential for financial leverage to be used as a tool in a geopolitical dispute. As tensions escalate over American strategic interests in Greenland, the sheer scale of European investment in the United States has emerged as a significant, if latent, point of leverage. The United States economy, particularly its government and corporate sectors, relies heavily on foreign capital to finance its deficits and fuel investment. European public and private entities are paramount in the system, holding approximately $8 trillion in American stocks and debt securities. This figure is staggering, representing roughly double the holdings of all other foreign nations combined. Understanding why this concentration of capital exists and what its implications are is crucial for policymakers, institutional investors, and anyone seeking to comprehend the mechanics of the modern global financial system. The conversation is not just about a hypothetical sell-off. It is about the structural power dynamics embedded within global capital flows and the potential for these dynamics to surface during periods of heightened political strain. The current friction finds its origins in a strategic overture from the United States president, who articulated a clear interest in gaining control over Greenland, a sovereign territory of the Kingdom of Denmark. This proposal was unequivocally rejected by both Danish and Greenlandic authorities, who emphasized the island's autonomy and stated plainly that it was not for sale. The diplomatic impasse quickly escalated when the American administration threatened to impose significant tariffs on European goods as a form of economic pressure. This threat of a trade war, however, prompted a counter-narrative to emerge from analytical circles, the possibility of Europe deploying its own powerful economic weapon. The concept is straightforward. If the United States leverages trade, Europe could leverage finance by initiating a large-scale sell-off of its extensive holdings of American bonds and stocks. The mechanics of such a financial countermeasure would be profound. A sudden and massive divestment from European entities would introduce an enormous supply of American assets onto the market. According to the basic principles of supply and demand, this would exert immense downward pressure on their prices. For the United States Treasury bond market, the bedrock of the global financial system, massive sell-off would drive prices down and inversely push yields, the effective borrowing cost for the United States government, sharply higher. This would immediately increase the cost of financing the national debt and could ripple through the entire economy, raising interest rates for mortgages, corporate loans, and consumer credit. Simultaneously, a deluge of American stocks hitting the market would likely trigger a severe downturn in equity valuations, eroding corporate wealth and impacting institutional and retail investors globally. This potential for systemic disruption underscores the immense financial leverage that Europe holds, whether it intends to use it or not. In response to the growing speculation about a European financial counterattack, the United States president has adopted a dual strategy of deterrence and diplomacy. Publicly, the administration has issued stern warnings, signaling that any attempt by foreign powers to weaponize their holdings of American keepers and assets would be met with severe retaliatory measures. This rhetoric, previously directed at Asian nations contemplating similar moves, was extended to European allies. The president cautioned that the United States would not hesitate to respond if Europe proceeded with a mass sell-off, though the specific nature of these countermeasures was left deliberately ambiguous. This calculated ambiguity is a common tool in geopolitical signaling, designed to create uncertainty and deter the opposing party from taking a preemptive action. The threat serves to remind all players that economic escalation is a two-way street with the potential for unforeseen consequences. This assertive posture was part of a broader and somewhat volatile diplomatic engagement. Earlier in the dispute, The American administration had announced concrete plans to raise tariffs on goods imported from 8 European countries, a direct move to apply economic pressure over the Greenland issue. This announcement amplified concerns and gave credibility to the idea that Europe might be pushed toward considering its financial options. However, the administration later reversed course, canceling the planned tariff hikes. This de-escalation was not unconditional. It was part of a complex negotiation aimed at resolving the underlying tensions. Reports suggest that in exchange for the postponement of new tariffs, the United States is seeking concessions related to its strategic objectives in Greenland. These include securing rights to deploy missile systems, gaining preferential access to the island's rich mineral resources partly to limit Chinese influence in the region, and reinforcing the presence of the North Atlantic Treaty Organization.
Oh.
This sequence of events illustrates the intricate interplay between military, economic, and financial leverage in contemporary statecraft. While a coordinated, large-scale sell-off of American assets by European entities could inflict significant damage on the United States economy, financial analysts are quick to point out that such an action would not be a one-sided affair. The interconnectedness of the global financial system ensures that the repercussions would be felt acutely in Europe as well. European banks, pension funds, and insurance companies are among the largest holders of the $8 trillion in American assets. A sudden crash in the value of these bonds and stocks would directly translate into massive write-downs on their balance sheets. This could trigger a solvency crisis within the European financial sector, forcing governments to intervene with costly bailouts and potentially sparking a broader economic recession across the continent. The very act of selling would harm the seller, creating a dynamic of mutually assured financial destruction that serves as a powerful disincentive against such drastic measures. Recognizing this, diplomatic channels have worked to de-escalate the immediate crisis. An agreement was reportedly brokered to persuade the United States president to definitively postpone the imposition of new tariffs on European goods. This move provided the necessary space for a more measured dialogue. In return for this concession on trade, the United States has continued to pursue its strategic goals in the Arctic through negotiation rather than coercion. The focus has shifted toward securing a long-term strategic partnership that would allow for an enhanced American military presence and privileged access to Greenland's resources. This outcome highlights a key principle of international relations. While the threat of economic warfare can be a powerful bargaining chip, the shared costs of its actual implementation often lead rational actors back to the negotiating table. The episode serves as a realistic operational scenario, demonstrating how the threat of financial disruption can alter political calculations and ultimately steer powerful nations away from a confrontational precipice. Beyond the immediate Greenland dispute, this episode has shed light on a broader, more subtle trend: the slow but perceptible decoupling of the European Union from the United States-centric financial system. For years, European policymakers have discussed the need to reduce their reliance on the dollar and American financial infrastructure, particularly in the wake of unilateral American sanctions that have had extraterritorial effects on European companies. Politico and other observers note that while this strategic shift is real, it is envisioned as a gradual, decades-long process, not a sudden rupture. A rapid, politically motivated divestment from American markets is still considered highly unlikely due to the catastrophic consequences for all parties involved. However, the recent geopolitical tensions have undeniably acted as an accelerant, shaking the confidence of some long-term holders of American assets. This shift is no longer purely theoretical. In a tangible reaction to the political climate, the Danish pension fund, Kådemaker Pension, announced its intention to divest $100 million from United States Treasury bonds, citing the unpredictable political environment as a contributing factor. Similarly, Greenland's own CSA pension fund is reportedly reconsidering the scale of its investments in American equities. While these individual actions are small in the context of the $8 trillion total, they are symbolically significant. They represent the first concrete cracks in a previously solid foundation of investor confidence. These developments demonstrate that the United States president's assertive pursuit of strategic interests in Greenland, while perhaps aimed at securing geopolitical advantages, has had the unintended consequence of highlighting Europe's significant leverage within American capital markets and prompting key institutional actors to begin however cautiously, to reevaluate their exposure. The system, for now, remains intact, but the underlying assumptions that hold it together have been visibly tested.